Wanted to take a look at the stock market today. And if you're someone who pays attention to how economic data affects the stock market, we've got a sleeper that hits on Thursday. Obviously, we have CPI and PPI data. PPI hits Tuesday, CPI data hits Wednesday. These are going to be important data points and will affect the stock market. But that sleeper, Thursday, no one's paying attention to this one. Everybody just sort of like, oh, yeah, okay. It's initial claims and continuing claims, which is an employment data point within the economy. It tells us how many people just got fired, and of those who just got fired, how many are still fired, laid off, whatever the case may be. Maybe disemployed, if you will, because of fires, because of hurricanes, because of other outlying factors. We got a lot of noise happening out of Washington, D.C., and Thursday's number might start becoming very interesting, and we'll see individuals filing claims, initial claims for unemployment insurance. Those numbers, I feel pretty strongly, are going to start to move higher. We've had the calm, now we get the storm. There's so much coming out of Washington, D.C. It's dizzying, and that's by design. I think we got tariffs again. I thought that they were delayed for 30 days. I kept seeing videos and news flashes over the weekend regarding tariffs hitting today. My understanding is now we have tariffs, even though they're supposed to be waiting for 30 days. This is by design. So if you're looking at all these data points, what do you focus on? And Thursday, I think, is going to be something that will really start to shift the stock market because employment or unemployment will start to increase. Let's jump in. I want to break down the stock market today, look at some key factors so you have a better understanding of this sort of ebb and flow. Again, this is dizzying chaos. And we will see an effect in the stock market. Let's jump in and I'll show you some charts I'm looking at. I want to start off looking at the U.S. national debt. This is one that, just look at this chart. Here's the thing. 97.5% of what he says, I'm completely against. But it's that 2.5%. It's like, listen, I totally co-sign that. Look at this chart. We are hitting every 100 days. And I saw a video with someone talking about this on TikTok over the weekend. I was just kind of cruising the couch, and this really hit. Every 100 days, we're getting $1 trillion added to our national debt. Pretty soon it'll be 90 days, then 80, 75. Every 50 days, every 25 days, $1 trillion added to the debt. Won't be long, our name is Argentina. So when you look at this, on the one hand, as a CEO, he's walking in saying, nope. On the other hand, it's not a company. It's a company in the sense it's an organization, but there's a board of directors that have already passed things that are in stone, and he can't change that. So he's trying to change everything else that he can. He's breaking as much as he can. This is one of the things he's looking at. Unfortunately, another thing he's doing is making this worse. Tariffs do not help at all. So it's going to be a lot of noise, and I don't see how that entire Congress and the president come together and say, we need to fix this. But this is one of the things that's driving his sort of modus operandi. And if you look at this, imagine what happens when we hit 50 days, $1 trillion. This is initial jobless claims. It's a sleeper. This number, it's a kind of this isn't going too far back. You can see some ebbs and flows here. We're not there yet, but we could be there this week or next. considering the freezes with money that he's already done. If you look at how the Federal Reserve had an effect on this, again, these are ebbs and flows. These are not numbers, 250,000, 200,000, 175,000. These are not numbers that are anywhere near recessionary. But they could become that. And we're going to see on Thursday, this number could easily pop higher because individuals basically just got frozen out because of the freeze on money. And we're going to see this across the board. So this is something on Thursdays is going to start becoming an interesting data point. Now, we just got unemployment numbers last week, Friday, and I did a video on that. Here's the thing. Unemployment, what the Bureau of Labor Statistics, the BLS, they do a survey. In my understanding, it's like 60,000 phone calls, the good old-fashioned way. They call and they ask the question, are you employed, yes or no? If you're not employed, how long have you been unemployed? And if it's a certain length of time, they say, oh, so you don't really, like over a year, year and a half, whatever it might be, you don't really want a job. Well, you could be a very specialized scientist and there's simply no work for you. Or you could be a stay-at-home girlfriend and maybe that's your job. So they consider the total workforce. Then they consider how many of those individuals are working within that workforce. Then the third thing is how many are not working, and that gives you the unemployment rate. Then we get non-farm payrolls, which shows us how many new jobs are created, and it could be a negative number. So that gives us a sense of how many, it's sort of like they look at how many people are being employed. Initial jobless claims show how many people are being unemployed. So they're the same, they're just completely different. The next chart is continuing jobless claims. This one, there's a week delay on this. The very first week, you are an initial claim. You just lost your job. Maybe the hurricanes in the Carolinas, Florida area, Georgia area. Those individuals would have filed initial jobless claims. The very next week, if you're still unemployed, you then become a continuing claim. So these are slightly elevated numbers. You can see when the Federal Reserve had to step in because the Federal Reserve pumped so much money into the system that it really accelerated the economy too much. Price pressures, housing, 70% of the price pressures we saw skyrocketed. Everybody's just getting ripped to pieces on housing. So you can see that there was a move higher in jobless claims, but as it turns out, these moves are muted when you look at the bigger picture. Let me show you that. Here's a bigger time frame for both charts. You can see initial jobless claims on the left there, and then continuing jobless claims. And they fairly mirror each other, obviously. Again, the breakdown. The very first week, you're an initial claim. The second week, you are a continuing claim. We are a long way away from anything that could be considered detrimental, but that could easily shift in 1 week's time. And because of that, the stock market might start getting jittery every Thursday if we see this Thursday a slight move higher. Now this becomes interesting because we're getting some tariffs. Okay, that is inflationary. The deficit will grow because of that. So on the one hand, our executive and his Treasury Secretary are trying to address the 10-year. Okay, don't do anything to add to the deficit is basically my advice to them on that one. They're doing everything they can to add to the deficit. The tax cuts, the tariffs will add more to the deficit, which would push the 10-year higher. So we may see inflationary data Tuesday and Wednesday, which could show that we're seeing price pressures, and the Federal Reserve would have to keep interest rate levels at least where they are, if not be threatening to push higher should they need to. On the other hand, tariffs will slow the economy down, but they will also add to the deficit. This is going to be a very chaotic year. Every day, every week, it's going to be a matter of what's next. Whereas previously we had a steady as you go, steady as you go, steady as you go. But unfortunately, that steady as you go was taking a look at the debt was straight down to the bottom. Now, however, we're getting chaos and we don't necessarily know where we're going to end up, although there are some attempts to stop that. Just unfortunately, he doesn't have access to everything. So he's trying to break anything. And he's trying to implement policies, but there's so much things he cannot do. And on some level, again, I kind of co-sign some of the things he's saying. Some. And I'm like, yeah, all right, I could bite into that. Yeah, I can see how you're trying to do that. On another level, he simply does not have the capability of implementing 100% of what he wants to try and do, which is both good and bad. So how do we get there? For now, this is SPY ETF, and I genuinely believe we've printed the high for now. And it may be for a while before we see that again. Inflation numbers, Tuesday and Wednesday. Employment numbers, Thursday. And if we start to see employment data points picking up, this means the economy is slowing down, which means revenues for companies start to deteriorate. A push higher in long-term interest rate yields would mean costs increase for everybody, businesses and consumers, and therefore less expenditures. Tariffs are not going to help. Tariffs are a tax. They will tax consumers. All that gets passed to the consumer. So it's a question of, hey, do you want to spend this much money on this product that came from China? Yes or no? No? Okay, well then whatever you do with your money, you do with your money. The hope is that it all comes back to the United States. That would take decades. It's not going to happen. Here's a better look at SPY ETF on a weekly basis. Again, I firmly believe we have printed the high, and we're going to start to see evidence that says that's it. He is artificially hitting the brakes on the U.S. economy. We will start to see employment numbers via initial claims moving higher, which means SPY ETF starts to move lower. At the same time, inflationary data, again, if some of these, like his tax cuts, are going to add more to the deficit, which would push the long end of the yield curve higher, which would cost more for consumers and businesses, and therefore revenues for companies will decline, contract, which means SPY ETF moves down. It's fairly kind of straightforward. UVXY ETF, this is the ETF for volatility, the VIX. And I think our days of calm and not really big spikes higher are behind us. Because any day now we'll be getting something that will be like, yeah, well, new policy. And the stock market didn't like that. And boom, we'll see a spike up in this. Anybody's been following my content for any period of time, I follow volatility. I trade volatility a lot. I trade interest rates. I trade commodities. I kind of trade the entire concept of the economy, every arm. I don't focus on just one thing. I see how certain things break down in various areas, and I take advantage of opportunities whenever I can. Here's one, for instance. This is XLF ETF. This ETF is the financial sector. All right, banks, things like this. If the long end of the interest rate yield curve moves higher, that's bad for banks because they can't lend out as much, is basically how that plays out. Plus, they have to pay out more for savings accounts and things like this. They're trying to get that differential in between. So we're seeing XLF ETF sliding lower. I took a look at some of the regional banks and the big bank ETFs. On Thursday, I think I am going to do an entire video on the financial sector and how all this is going to play out, and how XLF ETF is likely a good, we've probably printed the high there, and this particular one will swim to the bottom faster than, say, the technology sector. I'll put out a video on XLF ETF this week on that, kind of explaining that. U.S. 10-year Treasury yield had eased off a little bit. This is a big look backwards. Going back a few years, kind of give you an idea as to where the 10-year starts or is at this moment. It's elevated considering where it has been. The 10-year is the benchmark. Your mortgage rate starts by those individuals sitting there saying, what's the 10? And then it's maybe 10 plus the 2 points you pay over top for your mortgage, however they break that down. But the 30-year Treasury bond for the United States federal government, this is looked at via the markets. Supply, demand. If there's too much supply in the system, meaning the tariffs and other inflationary aspects create a bigger deficit. The tariffs will slow the economy down because of less expenditures. Tax cuts will mean less in tax take, which would mean a bigger deficit. Go back to the debt. That means it shoots straight up even further. This is the US 10 is where everything starts when it comes to a benchmark. The 30-year Treasury looks at the 10-year, and they kind of go off of each other based on expectations moving forward. That's a very basic kind of look at this, but it gives you the understanding. It's one of the reasons why I look at the 10-year all the time. It's my go-to. What's the 10? We're going to see this likely remain elevated. The tariffs and the tax cuts are going to increase the debt. Plain and simple. Which means there's going to be so much more supply of debt, which means price has to come down to entice investors in to buy that, which means interest rates goes up. At the same time, remember, the Federal Reserve is removing its own policies, reducing its balance sheet. They had stepped in because of COVID and created brand new money and consumed as much debt as possible, pushing the price up as much as they could to keep interest rates down as much as they could. At the same time, by the Federal Reserve stepping in and buying up all that debt, other financial institutions did not have to step in and sell off some other debt instrument to pick up the U.S.'s new deficit debt. That kept interest rates low. Now, all that's being reversed. Number one, the Federal Reserve is no longer there. Number two, the deficit's going to get bigger. So the 10 is going to likely continue to remain elevated, if not move higher. So mid-January, I put on a trade for gold. This is gold. GLD ETF is a great way to trade gold. If you're looking for an ETF, in the good old days, gold was your inflationary bug. Here's the thing. If the stock market moves lower because of inflation, because of tariffs and taxes shifting things and creating a bigger deficit, you would see gold prices moving higher, asset prices generally speaking. I sold some options short going into the end of the month for January, and I figured GLD ETF wouldn't go too much higher, that it would just sort of flatline. It kept going. And by pennies, those options did not get exercised. I won't be touching GLD ETF for a minute because this seems to be a runaway at this point. You can have any political sort of philosophy as you want, but the market is looking at things probably completely different. Tariffs are a tax. This will slow the economy. That slowing of the economy means the deficit will increase. The tax cuts will increase the deficit. Period. which is inflationary. GLD ETF will move higher. I'm not selling any calls anymore. Not for a while. We'll see how it plays out. USO ETF, I did a video at the beginning of the week, last week, regarding oil and what I see with him doing what he's doing. He's trying to artificially raise the price of oil for Canada so that Saudi Arabia and other OPEC producing countries can get their share of the U.S. market, artificially pushing the price of oil higher. When he was president, you could see the highs just before the collapse during COVID. If you take a look at what's going on with oil imports here in the United States, who got what when? Since COVID, Saudi Arabia and other OPEC producers have not recovered their share of imports into the United States, or in their case, exports. Canada has basically obliterated competition. They account for 62% of all imports here in the United States, Canadian oil. It's cheap, readily available, and at this point, we are 100% geared up to get that oil. Mexico's another 10%. So that's 70% of the market is those two countries. Which, two things. First, Trump just artificially, or will be artificially, raising the price of their oil here in the United States by a 10% tax. At the same time, Jared Kushner, Trump's son-in-law, has an interesting relationship with Saudi Arabia and other OPEC producers, where he got a fairly large, several billion-dollar investment infusion from those countries. So you kind of start putting two and two together. I expect oil prices to continue to move higher, which acts as a tax on consumers. The economy will slow down. Growth will slow down. Copper. This is the PhD of economics when it comes to what's going on. This is an interesting one. We used to look at copper and be like, what's going on with the economy? You want a leading indicator? You look at the price of copper. If you look at copper's data points, you can see a couple things. If the economy is expanding rapidly, prices of copper will move higher. There's been a breakdown a little bit of this because far more technology is involved and services involved in our economy here in the United States. But at the same time, in order to get that the technology moving forward, you need copper, all the wiring. But we're seeing prices moving higher for copper, and I expect this to continue, and this will equate to all other sort of cost points. Think about buying a house. All right, lumber prices are moving higher, copper prices are moving higher, other aspects of actually physically building the house, costs are moving higher, which means we're probably going to sell less houses or build less houses, which means housing prices will continue to be pressured upward. It's just too expensive. Then you've got the fact that the people who actually put the houses together just ran for the southern border. So work crews are diminished significantly, which will mean less houses are going to be built, which is going to be an interesting play on how that sort of extends throughout the stock market. I did an ETF video on the home builders. And while the home builders ETF had moved higher after I did that video, since then, the home builder ETF has been moving significantly lower, and I expect that trend to continue as well. So I'm going to continue to break down these things. How does economic data affect the stock market? Thursday, start looking towards Thursday as an important economic indicator. And at this point, PPI and CPI data, I'm kind of writing off because what drove those factors now are no longer relevant, that we have a whole new dynamic. that is in stone right now, and that stone could be shattered within the hour. The amount of content I could put out there that will be obsolete before I hit the publish button is going to be extraordinary. This is going to be a very chaotic ripping of the Band-Aid off. On some level, I'm fully aboard with some of the policies. I look at that debt and I think, we're done. Just start calling us Argentina, period. At least he's looking. We were maintaining status quo continuously, which means we were literally in a canoe going over Niagara. And everybody was on board with, let's just keep this thing moving. Well, we finally have someone who is trying to break everything. He's not going to be able to do 100% of what he wants to try and do. And that's going to create chaos in itself because he's never actually going to get there. Do I actually think the tariffs are going to work? Sure. We're going to see more steel workers. That hasn't been the foundation of our country since 1885. So I don't know how we win on that one. But there are other aspects of what he's trying to do that I'm like, okay, I could buy into that. Mostly, I sit there and I say, you're not going to be able to pull it off. You're just going to train wreck this a different way. I will be trying to put out as much content on how economic data affects the stock market as much as I can, but it's just going to be this massive thing continuously that's shifting every single hour. Make sure to hit that like and follow button, and good luck. It's going to be a wild ride this year.